Yeah. Yeah. Hey, Jim, listen, let's hope it's not a debt crisis, because there was a mortgage lender, Plano, Texas mortgage lender today, who filed for bankruptcy. To Rob's point, small, but things start small. What's your take on the risks to the second half of the year?
Well, so let me start with where Rob was, and I totally agree that the banking system's in pretty darn good shape. I mean, we just got those CCAR results. Look, this is not where we were 15 years ago with Lehman Brothers and Bear Stearns levered up 32 to 1, and AIG writing credit default swaps on anything that had a pulse. We're just not there. I would also, before I get to the risks, I would add one more positive, which is that if this is a technical recession, and by the way, NBER is the one who calls it, they're going to look at jobs. And I've never seen a recession where initial and weekly jobless claims, continuing claims, continue to stay as low as they have. It's diametrically opposed to what a recession is. In terms of the risks, I mean, the risks, in my opinion, are inflation that gets exacerbated by any of a number of things. It could be a policy mistake at the federal level. Hey, let's do more spending. It could be the war in Ukraine spreading, any of a number of things. But inflation, for me, it's really that's where this story lies. Positive or negative is inflation.
Jenny, though, I get Jim's points, okay, about this is not AIG, this is not these CDOs synthetic layered on CDSs and everything. But I worry about the consumer, and consumer debt as a percentage of household income is going up. It bottomed out during the pandemic. Nobody spent any money, but it's ticking back toward pre-pandemic highs. Revolving credit, i.e. credit cards, all those rates are going up. Consumer spending is all on the plastic. Is that a risk to the second half of the year? Facebook, Meta, one of your favorite companies, they talk about fierce headwinds in a conference call last night.
I mean, you can draw it all back to inflation being the problem, but you could also say, yes, consumer spending is the risk. The health of the consumer is the risk, because what's the U.S. economy? It's ultimately just the health of each of us and the way we're spending. What I think is happening right now is I think that spending is being reallocated. And when I think about this year and the second half, we know that wages have increased. We also know that expenses are up. And how those net out, we don't quite know yet. So we're just spending in really different ways than we did last year. And I think that's jarring, right? Where you see Apple sales might not be as good as they were expected to be, or we're not spending as much on Netflix and this and that. But I just read an article in the New York Times this morning, and it was showing the number of people at beaches and the number of people vacationing. And it says Airbnb, short-term rentals are still off the charts, and that AAA is expecting more people to drive this July 4th weekend than have ever driven before. Just the numbers are huge. So I'm looking at it like a reallocation of spending, and that's ambiguous to us as portfolio managers, to the market, frankly, to the economy. So we need to see where that nets out, and we won't know that yet. But we do need to watch the consumer health carefully. And Brian, to your point on percent of spending as a percent of disposable income, we both know that those numbers are still at 30-year or longer. As long as those numbers have been tracked, they're still at all-time lows. So I'm not too worried on that yet. We just need to watch it. It's definitely, to me, the thing that I worry about the most as a portfolio manager, the health of the consumer and how that just plays out.